Something is happening in the silver market. It's a shift so profound it's practically screaming, but only if you know where to listen. On January 20th, 2026, while most of the world was focused on stocks, silver did something extraordinary. It didn't just climb, it exploded, surging past $95 an ounce. That's a nearly 6.5% jump in a single day. In the last 12 months, it has gained over 210%. But this isn't just another number on a screen. This isn't about day traders chasing a hot trend. This is a signal. For decades, silver has been the quiet, overlooked cousin of gold, an industrial metal, a secondary thought. But its recent violent move upwards isn't a random fluctuation. It's a message from the deepest corners of the global economy, a warning that the foundational trust in our financial system is beginning to crack. While the crowd is mesmerized by the flashing lights of digital currencies and tech stocks, a quiet, powerful migration is underway, a move from paper promises to hard, physical assets. The question you should be asking isn't why is silver going up? The real question is, what is silver telling us about what's coming next? To understand what's happening right now, you first have to understand silver's historical role not just as a metal, but as a psychological barometer. There's a concept in economics known as fear money, and silver is its ultimate embodiment. When public faith in governments, banks, and the fiat currencies they issue begins to erode, people instinctively seek refuge in assets that can't be printed into oblivion. Gold is the choice of central banks and the ultra-wealthy. But for the average person, silver has always been the answer, a tangible, affordable store of value that you can hold in your hand. This isn't a new phenomenon. It's a pattern that has repeated itself with stunning predictability during every major economic crisis of the last 50 years. Think back to the 1970s, a decade defined by crippling inflation and the death of the gold standard. As the purchasing power of the dollar plummeted, people fled to silver, sending its price into the stratosphere. It was a desperate attempt to preserve wealth in the face of currency debasement. Fast forward to 2008. As the global financial system teetered on the brink of collapse, with behemoth banks like Lehman Brothers vanishing overnight, where did people turn? Again, to silver. Its price surged as it became a hedge against systemic financial failure. And again in 2020, as governments around the world unleashed unprecedented waves of monetary stimulus to combat the pandemic lockdowns. Fears of inflation drove another massive wave of buying. In each case, the sequence was the same. A crisis of confidence in the established system led to a flight into silver. The metal's price action wasn't the cause of the crisis, it was the effect. It was the canary in the coal mine, singing its warning before the broader market fully grasped the danger. What we are seeing in 2026 is a powerful echo of these historical moments, but with a terrifying new intensity. The surge isn't just a reaction, it's an anticipation of what's to come. It reflects a deep and growing anxiety about persistent inflation, unsustainable government debt, and the very stability of our digital, interconnected financial world. Macroeconomic strategist Tom Bradshaw puts it bluntly, warning that the rally in precious metal signals alarm that the fiat currency system is under enormous pressure. The money flowing into silver today is fear money. It's a vote of no confidence in the future of paper assets and a desperate search for something real in a world of digital abstractions. For decades, the story of silver was a tug-of-war between its role as money and its role as an industrial commodity. In times of economic recession, its industrial use was often seen as a weakness. But that narrative has been completely torn apart. The industrial side of the equation is no longer a drag. It has transformed into a relentless, unyielding engine of demand that is fundamentally reshaping the entire market. This isn't a cyclical trend. It's a structural revolution, and it's being driven by the single most dominant technological shift of our time, the transition to green energy and electrification. The secret lies in silver's unique physical properties. It possesses the highest electrical and thermal conductivity of any metal on the planet, making it utterly indispensable for modern technology. There is often no viable substitute. Attempts to replace it in critical applications have either failed or resulted in drastically inferior performance. Consider the solar panel industry. Silver is a critical component in the photovoltaic cells that convert sunlight into electricity. With global solar capacity expected to quadruple by 2030, the demand for silver from this sector alone is staggering. The solar industry is now a primary driver of industrial demand, consuming a massive and growing portion of the world's silver each year. Then there are electric vehicles, EVs. An internal combustion engine car contains a small amount of silver. An EV, however, uses significantly more, woven into its battery management systems, power inverters and charging components. With global EV production projected to soar in the coming years, this sector is creating a massive new artery of demand. But it doesn't stop there. Silver is essential for 5G cellular infrastructure, for the semiconductors that power our computers and smartphones, and for the explosion in AI data centers that require immense electricity loads. Even medicine relies on it for its powerful antibacterial properties in devices and wound dressings. This isn't speculative demand. This is physical, industrial consumption. And this is the most crucial part to understand. Unlike gold, which is mostly hoarded and can be melted down and resold, a huge portion of the silver used in industry is consumed in such tiny quantities within each product that it is never economically viable to recover. It is effectively destroyed, removed from the global supply forever. What this creates is not just demand, but a structural, one-way flow of the metal out of vaults and into technology. It underpins the silver price with a hard floor of real-world use that grows stronger every single year. The monetary demand from investors is the wave that crashes on the shore, but this industrial demand is the powerful deep ocean current that is pulling the entire market in one direction. It's the side of the story that most people have missed, and it's the reason why this time the silver story is fundamentally different. And if you're starting to see why this isn't just about old coins, but about future technology, make sure you subscribe and hit the bell icon. You won't want to miss where this story goes next. So, if demand is exploding from both fearful investors and the world's most critical industries, the logical question is, why don't we just mine more? The answer to that question is the second half of our perfect storm, and it reveals a catastrophic flaw in the global supply chain. The simple, brutal truth is, we can't just ramp up production. The reason is one of geology and economics. The vast majority of the world's silver, over 70%, is not found in primary silver mines. Instead, it is extracted as a byproduct from mining operations for other industrial metals, primarily lead, zinc, copper, and gold. This fact is absolutely critical. It means that the global supply of silver is not determined by the price of silver. It is a hostage to the economics of base metals. A copper mining company, for instance, decides whether to expand or shrink its operations based on the price of copper, not the price of the small amount of silver it happens to pull out of the ground alongside it. So, even as silver's price skyrockets, if zinc or lead prices are weak, there is simply no incentive for miners to produce more. This creates a severe supply inelasticity, a market that is physically incapable of responding quickly to soaring demand. This fundamental mismatch has pushed the silver market into a state of chronic and deepening deficit. For 5 consecutive years, the world has consumed far more silver than it has produced. In 2025 alone, the market entered its 5th straight year of a structural supply deficit. Between 2021 and 2025, some estimates place the accumulated shortfall at nearly 900 million ounces, drawing down the identifiable above-ground stockpiles that act as a buffer for the market. Think about what that means. We are burning through our savings. The inventories held in vaults in London and New York, which for decades provided a cushion, are being steadily drained to fill the gap between consumption and mine production. This isn't a forecast, it's an accounting reality. This tightening of physical supply is now showing up in the sophisticated corners of the market. We're seeing persistent backwardation in the futures market. This is a rare and urgent signal where the price for immediate physical delivery of silver is higher than the price for a contract to deliver it in the future. It's the market's way of screaming that it needs the metal now and is willing to pay a premium for it, indicating an acute physical shortage. Compounding this, some governments are beginning to recognize silver's strategic importance, with reports of state actors like Russia moving to purchase precious metals for their reserves, further tightening the screws on an already strained supply. The machine is breaking. Decades of assuming an endless supply of cheap silver to fuel our technological ambitions have collided with the geological reality that you simply can't print a physical element. The deficits are no longer a theoretical problem for the future. They are here, and they are getting worse. We are running out of readily available silver, and the market is just beginning to wake up to this terrifying fact. The twin forces of historic monetary fear and an unprecedented industrial demand shock are powerful on their own. But what has turned this into a full-blown price explosion is the arrival of a perfect storm of macroeconomic and geopolitical triggers, all converging at the same moment. These are the sparks that have ignited the fuel. First and foremost is the issue of persistent inflation. For years, official government statistics have reported modest inflation figures, but these numbers often feel disconnected from the reality people face every day at the grocery store or the gas pump. The cost of living has been climbing steadily, eroding the value of savings and wages. Silver, for centuries, has been the ultimate hedge against this slow, insidious theft of purchasing power. As faith in central banks' ability to control inflation dwindles, investors are increasingly turning to the hard certainty of physical silver. Second is the alarming rise in geopolitical instability. The global landscape feels more fractured and unpredictable than it has in decades. We see this directly impacting the silver market. For example, recent threats by the US to impose tariffs related to a dispute over Greenland immediately sent a shockwave through the markets, causing a spike in demand for safe haven assets like silver. Events like this serve as brutal reminders of the fragility of our globalized system and drive capital toward assets that are immune to political whims. When trust between nations breaks down, trust in physical money goes up. Third, and perhaps most importantly, is the anticipated shift in monetary policy. After a period of raising interest rates to combat inflation, major central banks like the US Federal Reserve are now signaling that rate cuts are on the horizon. This is pure rocket fuel for silver. Lower interest rates accomplish two things. They tend to weaken the US dollar, which makes silver cheaper for foreign buyers, and they reduce the opportunity cost of holding a non-yielding asset. When cash in the bank earns you little to no interest, the appeal of owning a tangible asset like silver, which has no counterparty risk, grows immensely. The market is anticipating a future of negative real interest rates, a condition that has historically correlated with explosive performance for precious metals. Finally, all of these factors feed into a broader, more existential theme, a profound erosion of trust in our institutions. From banks to governments to the very concept of unbacked digital money, a sense of fragility permeates the system. Holding physical silver is, for many, an act of opting out. It is a personal reserve asset that exists entirely outside the digital financial infrastructure, a form of wealth that cannot be hacked, deplatformed, or diluted by a keyboard stroke. This isn't just one factor driving the price. It's the convergence of all of them. The inflation hedge is meeting the geopolitical hedge, which is meeting the currency debasement hedge, all at the precise moment that the industrial and supply fundamentals have reached a breaking point. It is a rare and powerful alignment of forces that is creating one of the most compelling investment narratives of our lifetime. With silver shattering records and entering a state of price discovery, the question on every investor's mind is, how high can it go? While forecasting is always a matter of informed opinion rather than a certainty, a powerful consensus is forming. And the numbers being discussed would have seemed absurd just a few years ago. Before we look at price targets, we have to talk about the gold to silver ratio. This is a simple metric that tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, the ratio has seen dramatic swings. When it reaches extreme highs, like the levels above 100 to 1 seen in early 2025, it signals that silver is profoundly undervalued compared to gold. What typically follows is a violent reversion, where silver dramatically outperforms gold as the ratio compresses. That is exactly what we have just witnessed. The ratio has collapsed from its peak, reflecting silver's explosive 147% surge in 2025, which more than doubled gold's impressive gains. This isn't speculation. It's a historical pattern of mean reversion, playing out in spectacular fashion. Now, let's turn to the forecasts. The conservative end of the spectrum comes from major banking institutions, which have historically underestimated silver's potential. Bank of America has suggested a peak around $65, while other major banks' averages fall in the $56 to $65 range. Peel Hunt, a brokerage, has a more bullish full-year forecast of $75/Oz for 2026. However, it's crucial to note that with the spot price already blasting past $94, many of these bullish institutional forecasts have already been left in the dust. This is where the more specialized analysts, who focus on precious metals, step in. Their targets paint a far more dramatic picture. The renowned investor Peter Schiff has called a $100 price per ounce a very realistic target for 2026, suggesting the old ceiling of $50, $70 has now become the new floor. Robert Kiyosaki, author of Rich Dad Poor Dad, sees silver going to $200 per ounce by the end of 2026. Analysts at the De Beer Group are even more aggressive, projecting silver could reach $200 per ounce by the end of 2026. And looking further out, strategist Tom Bradshaw has put forward a target of $375 by 2028, viewing the current rally as a signal of deep stress in the fiat currency system. These are not wild guesses. They are projections based on the collision of structural supply deficits with exponential industrial and monetary demand. Of course, no asset moves up in a straight line. After such a parabolic run, volatility is guaranteed and pullbacks are healthy. Technical analysts are watching key support levels, with some seeing a solid base in the $69, $72 range, which could present buying opportunities on any significant dips. But the overall sentiment is clear. The paradigm for silver has shifted. The forces that have been unleashed are not short-term in nature. They are structural, powerful, and may only be in their early innings. The sudden, explosive rush into silver is not just another fleeting market frenzy. It's a profound fundamental repricing of an asset that sits at the intersection of our past and our future. It is simultaneously a vote of no confidence in the stability of our monetary system and a vote of extreme confidence in a future powered by green energy and advanced technology. What we are witnessing is the collision of two unstoppable forces: the timeless human impulse to seek safety in tangible assets during times of fear and uncertainty, and the insatiable forward-looking demand for a metal that is critical to the technological infrastructure of the 21st century. Combined with a supply chain that is fundamentally broken and incapable of keeping up, you have the ingredients for a market supercycle. The surge to over $95 an ounce is not the peak of a bubble. It is a signal, a loud, clear, and urgent warning. It tells a story of deepening supply deficits that can no longer be ignored. It speaks of a world losing faith in paper promises and waking up to the enduring value of physical reality. For the discerning investor, the message is not to chase the price in a panic. It is to understand the powerful undercurrents driving this move. The rush into silver isn't the crisis itself. It is the final warning siren, the last, echoing signal before the true economic storm makes landfall. The smart money isn't just buying silver, it's listening to what it's saying.